Welcome to the video on the myth of index fund consolidation and why selling identical ETFs can be a costly mistake. In this episode, we'll unpack when consolidation makes sense and when it's smarter to hold and redirect. Let's begin by setting up the agenda and flow for the video. Here's our roadmap. First, we'll define the consolidation trap. Next, we'll compare the tax impact versus expense ratio differences. Then, we'll walk through a step-by-step plan to address redundant funds without selling. After that, we'll use decision diagrams to simplify choices. We'll also cover the exceptions when consolidation does make sense. Finally, we'll test your understanding with 2 quizzes and close with key takeaways. Let's move to the core idea. The consolidation trap is the urge to sell appreciated positions in order to simplify a portfolio that holds 2 nearly identical index funds. While simplification is intuitively appealing, selling purely to consolidate can create a tax bill that far exceeds the savings from a minor expense ratio difference. With that principle in mind, let's examine why the math usually favors holding and redirecting rather than selling. Investors are often tempted to consolidate because a cleaner portfolio feels better, and because they perceive one fund as more efficient. Minor differences in expense ratios can appear meaningful. However, the hidden cost is that selling appreciated positions in taxable accounts realizes capital gains, potentially creating an immediate tax bill that overwhelms any long-term expense savings. Therefore, the desire for tidiness can lead to an economically suboptimal decision. Now, to make the decision easier, let's look at a structured flow. This flowchart begins by asking whether the position is in a tax-advantaged account. If it is, selling is generally acceptable because there is no capital gains tax. If not, the next branch asks whether the investor falls into the 0% long-term capital gains bracket. If yes, then partial or full consolidation may be done up to the bracket threshold. If not, the chart asks whether the position is at a loss. If it is, tax loss harvesting can allow a switch with potential tax benefits. If it is not at a loss, the recommended path is to hold both funds, stop buying the redundant one, redirect all new contributions to the preferred fund, and reinvest dividends into that preferred fund. The process ends with a periodic review to reassess bracket and account conditions over time. Now that the path is clear, let's turn this into a concrete action plan. Here are the steps. First, stop contributing to the redundant fund. Next, direct all new purchases into your preferred fund, typically the one with a slightly lower expense ratio or better structure. Then, reinvest dividends into that same preferred fund. Use ongoing cash flows to slowly tilt your holdings without realizing gains. Annually, review specific tax lots for opportunities, such as realized losses, a year when you fall into the 0% long-term capital gains bracket, or charitable gifting of appreciated shares. Only sell appreciated shares in taxable accounts under special conditions like those mentioned, or when there is a truly material difference rather than a trivial expense ratio change. With the plan in place, let's quantify why taxes usually dominate the expense ratio savings. Consider a scenario where the investor has a $10,000 unrealized gain in a taxable account. Selling to consolidate would realize the gain and could trigger a 15% long-term capital gains tax of roughly $1,500. By contrast, consolidating to a fund with a 2 basis point lower expense ratio on a $50,000 position saves about $10 per year. In this example, the one-time tax cost dwarfs the ongoing savings, often by orders of magnitude. Therefore, the economic case for selling is weak unless there are special circumstances. Next, let's compare the pros and cons of immediate consolidation versus holding and redirecting. On the left, consolidating immediately provides an instantly cleaner portfolio, fewer tickers to monitor, and potentially a small reduction in expense ratio. On the right, holding and redirecting avoids a capital gains tax bill, preserves compounding by keeping invested capital intact, and moves you towards simplicity gradually through new contributions and dividend reinvestment. For most taxable investors with appreciated positions, the right column is the economically superior path. Now, let's translate these rules into specific scenarios with a quick table. This table summarizes consolidation decisions. In tax-advantaged accounts like IRAs and 401ks, selling is generally fine because there are no capital gains taxes. In taxable accounts, if you fall into the 0% long-term capital gains bracket, you may sell up to the threshold, considering any state tax implications. If your bracket is above 0, selling appreciated shares is usually not advisable because the tax bill outweighs minor expense savings. If the position is at a loss, tax loss harvesting enables a beneficial switch. Finally, if there is a truly material difference between funds, reassess by quantifying tracking differences, structure benefits, and the tax impact. With scenarios in mind, let's add an important disclaimer. This content is for educational purposes only and is not investment, tax, or legal advice. Always consult a qualified professional before acting. Tax rules, state regulations, and the 0% long-term capital gains thresholds can change and may vary by location and personal circumstances. Now, let's visualize how gradual consolidation unfolds over time. This timeline shows how to implement gradual consolidation. In the first quarter, stop purchasing the redundant fund and redirect to the preferred fund. In the second quarter, reinvest all dividends into the preferred fund. In the third quarter, review tax lots for losses and check whether your tax bracket has changed. In the fourth quarter, consider charitable gifting of appreciated shares. In the following year, reassess whether a 0% long-term capital gains window exists for partial consolidation. With the strategy in place, let's test your understanding with a quick quiz. Question: you hold two nearly identical S&P 500 ETFs in a taxable account with large unrealized gains. The expense ratios differ by 2 basis points. What is the best move today? Option A: sell the higher expense ratio fund now to tidy up. Option B: hold both, stop buying the redundant one, and redirect new money to the preferred fund. Option C: sell both funds and start fresh. Option D: switch monthly between them to average taxes. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is to hold both, stop buying the redundant one, and redirect new money to the preferred fund. The reason is that realizing gains to consolidate would likely create a tax bill that exceeds the minor expense ratio advantage. Redirecting cash flows gradually moves you towards simplicity without incurring the immediate tax cost. Next, let's solidify the idea with a case study and an additional visual. In this case study, the investor has $120,000 in a taxable account split across two S&P 500 ETFs, with $24,000 of unrealized gains. Selling one ETF to consolidate would trigger approximately a 15% long-term capital gains tax of $3,600. The expense ratio difference is 2 basis points, which on $120,000 amounts to about $24 per year. The implied break-even is roughly 150 years, making immediate selling unjustifiable. The smarter path is to hold both funds, redirect new contributions to the preferred fund, reinvest dividends into that fund, and watch for opportunities such as losses or a 0% long-term capital gains window. Let's do another quick quiz to reinforce the exceptions. Question: when is consolidation by selling appreciated shares generally acceptable? Option A: when funds are in an IRA or 401k, or when you are in the 0% long-term capital gains bracket up to the threshold. Option B: when your expense ratio difference is at least 2 basis points. Option C: whenever both funds track the same index. Option D: when your brokerage offers commission-free trades. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is that consolidation by selling appreciated shares is generally acceptable in tax-advantaged accounts like IRAs and 401ks, or when you are in the 0% long-term capital gains bracket and can realize gains up to the threshold without incurring federal taxes. Keep in mind that state taxes or other rules may still apply. To reinforce pacing and execution, let's look at a Gantt-style view of a one-year plan. This Gantt chart breaks the year into 4 phases. In months 1 through 3, you stop purchases in the redundant fund, redirect contributions, and set dividend reinvestment to the preferred fund. In months 4 through 6, monitor tax lots and evaluate opportunities for tax loss harvesting, while checking whether you might qualify for a 0% long-term capital gains bracket. In months 7 through 9, consider charitable gifting of appreciated shares and continue redirecting contributions, reviewing any material tracking differences. In the final quarter, complete year-end tax planning, and, if a 0% window is available, perform partial consolidation throughout. Maintain rebalancing through contributions rather than taxable sales. Now let's crystallize the most important lessons. The key points are as follows. First, do not pay taxes merely to achieve cosmetic simplicity. Second, small expense ratio differences between nearly identical index trackers are usually negligible. Third, tax efficiency typically beats micro-optimizations. Fourth, consolidation is straightforward in tax-advantaged accounts but requires caution in taxable accounts. Finally, use ongoing contributions, dividend reinvestment, and time to gradually simplify. With these points in mind, here is a brief summary. To summarize, when you hold overlapping index funds in a taxable account, avoid selling for the sake of neatness. Instead, stop adding to the redundant fund and redirect all new cash flow and dividends to the preferred fund. Only sell if you are in a tax-advantaged account, you are realizing a loss, or you can use a 0% long-term capital gains window. Let time and ongoing contributions gradually deliver simplicity, and review annually for changes. Thank you for watching. If you found this helpful, please like, share, and subscribe. Let us know in the comments which fund you plan to redirect contributions to first, and what questions you want us to cover next.